Hi, this is Charlie Jewett here from the Renovating Retirement Podcast. And after reviewing thousands of financial plans over the last 16 years, I thought that it would be really useful to create a simple, short video that really kind of sums up what I think has changed in the industry and some small steps that people can make that are basically, I mean, I don't know if we're allowed to use the word guarantee, but very, very high probability that you're going to increase your retirement income by 20 or 30%. And when things change, we have to change with it. You know, the blacksmiths needed to see the car coming, and the people that fought it didn't do so well, but people that saw themselves as in the transportation business did a lot better. There was a time in the financial services industry where we didn't need stocks, bonds, and mutual funds, or what we call asset allocation and diversification. All we needed was the bank. Some of our grandparents and parents, great grandparents, sold the family farm, stuck the money in the bank, making 8%, and literally just lived off of that 8%. That was a very simple financial plan. So why don't we still do that today, or whatever changed it? Well, the rates at the banks went down so low that people could no longer live off of that simple interest or the interest they were earning. So that's where really today's modern portfolio theory and asset allocation and trying to use the stock market came from. It was from very intelligent people going, holy smokes, something has stopped working. How are we going to get the rate of return that we need? And that worked for a good long time. We are in a situation now where it's absolutely essential that you understand that that same type of a change is coming. The stock market over the last 20 years has not been working the way it did in the beginning. And if you put your head in the sand and don't see that, or have a rigidness and an unwillingness to change or learn new things, your retirement's going to suffer, and possibly every generation after you will have less wealth, or a lower number of assets. So let me just cover three really short, simple things as an introduction. And then if you'd like to know more information or get on the phone with somebody, you can talk to the person that showed you this video, thank them, give them a high five if we're allowed to do that at that time. I'm recording this during the coronavirus, so there's always going to be comments about whether we can high five or shake hands. Just thank them for the video and then ask them what the next step is. So let's jump into this. The three simple changes I'm going to teach you are: you need to be earning a real rate of return. Don't lose money. Losing money is actually optional. Used to work very well, now doesn't. And don't pay taxes. What do I mean by that? Let's jump into this and go one at a time. The first thing I want to look at is a chart that I recorded years and years ago. You can actually see the bottom. You can see what was open on my computer at the time, and I've used this so many times. Thank you so much, Len Rainier at the Wealth and Wisdom Institute, for putting this out. But I learned something, the difference between average rate of return and actual rate of return, that I to this day call the most important thing you could ever learn about money. If you take a look at this picture right here and you say, what if I put in $1,000? Now, obviously people have more money than that in their accounts, but I just want to use a simple example. What if you put in $1,000? If I could tell you I could make you 20% rate of return for the rest of your life, would you be happy? And the answer is yes. And that's actually why people use the stock market or money managers, is because they've heard or been told you can make 6, you can make 7, 8, 9, you can try to make 7 to 10% really. Some advisors say 12. That seems a little high from my research, but 7 to 10% is the reason why you're there, paying fees and taking risk. Well, what's not told to you, and nobody cares more about your money than you, so you need to learn this and understand this is not a real rate of return. This is what we call the mathematical mean, or the average. And there's an infinite number of different ways to earn 20%. Some of them grow your account. Some of them you end up with zero. Well, the only name of the game, I mean, the only thing we're trying to accomplish here in, investment advice or retirement planning is growing the size of your account. We're not chasing some fake interest rate. We're trying to add money to the account. So take a look at this and so you'll understand what I mean. If in the first year you put in $1,000 and it went up 20%, and the second year went up 20%, how do we calculate the average? You add the two together, that's 40%, divided by the number of years, 2 years. We are averaging 20%, but the account is at $1,440. Yay! That is the best possible way to earn 20%, or any percentage on any account, is for it never to go down and it be a fixed rate of 20%. Now, first question, is the stock market providing a fixed rate at any percentage? Does it make 8% every year for the rest of your life, or does it bounce around? If it bounces around and makes that 7 to 10% or whatever you get in any other way besides this first one, you're guaranteed to have less money than you expect. If you use any financial planning calculators and say, I'm going to compound my money at 6 or 7 over the next 20, 30 years and then try to live off of it, you will 100% of the time have less money than you planned on if you are in the stock market, because it doesn't give a fixed rate of return. It bounces up and down and averages out to really a fake rate of return. Why is that? Here's examples. I understand the stock market doesn't take these huge swings. It takes smaller swings, but the concept is what you need to grasp here. What if the first year your 1,000 went up 60% and then you lost 20% of that much bigger number? Because 20% of a bigger number is more of your cash, it's more of your account. Your account cannot be as high as it was in the first example. But what are we averaging? What is your statement allowed to say? What can your broker tell you or your advisor tell you he's accomplishing for you or she's accomplishing for you? Well, 60 plus a negative 20 is that same 40% divided by the same 2 years. We're still averaging 20%, but we only have $1,280. What about this one? When I teach public seminars, people tend to be shocked and ooh and ah over this. If it goes up 100% from $1,000 to $2,000 the first year, why is the only reason that people use the stock market its unlimited upside potential? They're truly hoping the stocks and mutual funds they buy will go up high interest rates like 60 or 100. So your 1,000 doubles to 2,000, then we lose 60% of the 2,000. You have 20% less money than you put in 2 years earlier, but what are you averaging? 100 plus negative 60 is 40 divided by 2. And my favorite, go to any casino, put in $1,000, you're up 140%, and then you lose 100% of it. Losing 100% of any amount of money means you are left with zero on the streets, living out of a truck. But everybody that walks by, you're like, hey, I'm making 20%, guys, because it went up 140, down 100. That leaves the 40 divided by 2 years. This is the most important thing that you'll ever learn about money. There was a time, this is the kind of weird things I do in the middle of the night when I can't sleep. There was a time where I opened up Excel and I put every possible version of earning 8% that I could think of. So 30 years of earning 8, 30 years of it going up 9, then going down, whatever it was, like 7 or something like that. I basically put every combination I could think of. There's infinite combinations, so I couldn't do them all, but I put a lot. They all averaged 8 at the bottom. So they're all 30 years long. At the bottom, when I summed up, the total of the interest rates and divided by 30 years, they all said 8%. Here's the graph that says what amount of money you would have ended up with. Anywhere from basically $900,000 down to the exact same money that you put in. And do you have control over which one you get? And the answer is a big whopping no. This is what's concerning. After reviewing 2,000 or 3,000 financial plans, almost everybody that shows us their current financial plan or what their current advisor has done for them, they're in variable investments. They're in securities. They're in stocks, bonds, and mutual funds that can go up and down. The advisor doesn't control it, nor do you control it, how much money you're going to actually end up with. You may have a neat percentage at the end on your statement. Hey, your advisor's like, I did a great job. I earned you 6.5 for your entire life, or I earned you 12 for your entire life. The problem with that is retirement planning is about building a nest egg, not building a fake number that you can hang on the wall on some sort of a plaque. It's about how much money you actually end up with, because that nest egg, that money, is all you're going to have when you go into 30 or 40 years of unemployment. We must focus on real rate of return and growing the account year after year after year. Compound interest is the eighth wonder of the world, not average rate of return. So it's very important that we're earning a real rate of return. When does less interest give you more than more interest? Or when is low interest better than high interest? This was shocking to me. If you'll notice, when I did this research, it was from 2000 to 2013. I used to be a part of a registered investment advisory group called Global Financial Capital. And Global focused on kind of safe growth strategies. So you'll notice that it went up 7.4. This is a global account, went up 9.9, 4, 2, 5. You don't see any zeros in here, which is really the goal. Nothing huge, no big years. We averaged, or Global at that time averaged 6.98. Let's compare that to the S&P 500 in those same years. Big years. Well, big losses, and then a big year, blah, blah, blah. There's a giant loss. This is what destroys retirement, by the way, the negative 22 and the negative 37. The positive 26 and positive 28 are not enough to make up for that, even the positive 32. At the bottom, you can see that the S&P averaged over that time period 8.22% interest, and the global account only averaged 6.98. Any advisor or salesman who's somewhat skilled is going to be able to get you to invest in the 8.22 with some very simple questions. Mr. and Mrs. Jones, which would you prefer, 8.22% or 6.98%? Or they may take you to a compound interest calculator and show you that though that looks like just, 1.25% higher, that doesn't mean you end up with 1.25%, or 25% more at retirement. You may end up with 2 or 3 times as much money when you add rate of return like that because of the way compound interest works. Here's the issue. Ignore the interest rate and look at the 2013 balance. The global account is 223,000. The S&P account is 204,000. That's why I'm saying you must focus on a real rate of return. The way to do that is to stop the losses. When you never go below zero, your rate of return is your rate of return. So less than 7 gives you more money than 8.22, depending on how you choose to earn that particular interest rate. Another example of why this is so important is one of these days, and maybe you're there now, maybe you're watching this video and you're in retirement. One of these days, you're not going to be growing your assets. You're not going to be in the accumulation phase of retirement. You're going to go into the distribution phase of retirement. This is where you've saved up a nest egg. You've gone into that 30 or 40 years of unemployment. You may have some Social Security coming in, but it's probably not enough to provide the lifestyle you wanted. So you're now going to take distributions or take an income stream off of your nest egg. Look at Steve and Bill. And it's funny, my recording software is in front of his name. Look at Steve and Bill and Jim, all right? We have Steve and Bill and Jim, and Steve is going to earn 8.25% for the whole time he's taking his income. I think this is 20 years. Bill's going to earn 8.25%. Jim is going to earn 8.25%. If Steve and Bill and Jim were at a party comparing their annual statements with each other, which no one does, but if they were at a party and they brought their statements and like, look what my broker did. And it's like, no, look what my broker did. And the other guy's like, look what my broker did. They'd all go, oh my gosh, they're neck and neck. It's a tie. We're all making 8.25%, which is higher than safe investments can provide. Pat ourselves on the back. Good job for being in the market. But there's more to the story. Distributions change everything, and how you earn the 8.25% changes everything, and you don't control that. So this will always be gambling, where you don't know until after the 20 years how it worked out. Steve's 8.25% comes in a low loss, a nice high, a high, or a gain, really nice, little one, huge. Got a lot of gains in the early years. Yay, Steve. He's taken out $30,000 from $500,000. That's a pretty high withdrawal percentage. And down here at the bottom, he's got more money than he put in. Some of the years he's got 1.1 million. Yeah, $1.12 million in 2007. Yay, Steve. Well, Bill's advisor, who's tying Steve's, getting him the 8.25% interest, he's just getting it in a different order. And all we did was switch around so that some of the lows were in the early years, and we're just really saying no one knows what the market's going to do or how it's going to give you whatever interest rate you earn. But how it comes, that one mystery that no one controls, how you get it, decides whether you run out of money or not. Bill's 8.25 doesn't come in a favorable order. Even though his advisor could brag, say he's making 8.25, Bill is out of money in 2006. Jim doesn't run out of money, but his $500,000 in 2000, or by the year 19 or 20, is down to, what is it down to? It's down to $158, $154. So that's what we call sequence of return risk. And it's probably the most important problem or risk that retirees have is they use their accumulation strategy that worked from 1970 to 1999, the stock market growth, while they're in the distribution phase. Accumulation tools and accumulation strategies do not work the same in the distribution phase. You need distribution tools or things that are focused on income, creating a safe income that lasts as long as you both shall live. Now, I mentioned that a change has come to the world that's very hard to see, and most brokers are not sharing it with you because you would move the money from them. You would move the money into strategies with a real rate of return that don't experience as losses like 10, 20, or 30%. And what do I mean by this? Let's go back in history a little bit. People used to have farms. Wealth was animals and crops. If you look at these beautiful lambs and sheeps here, and you had 100,000 sheep, and one day a plague came through and 30% of your sheep died, you're going to get less lambs. It's just bottom line. 70,000 sheep don't create as many baby lambs as 100,000 sheep. You have to wait for that flock to get back up to the size it was, and you will not have as many lambs. Well, those lambs are your interest. That's the income you have to live off of in retirement. You cannot afford those losses in retirement. Corn, crops, same thing. If a plague or a pest or something, a fire wiped out some of your crops, you're not going to have as much food. Now, from 1970 to 1999, the stock market real rate of return, not the baloney math above it, not the 15%, which is the mathematical mean I just showed you, the real compounded rate of return for that 29-year period was almost 14%. I say it this way every time. I would be a criminal and should be reported if during that time I told people to use safe tools that give them a real rate of return of 6.98, like I showed with that global account, or some sort of a income-based tool that gives a guaranteed income for life of 6% of your nest egg without ever losing money. I'd be a criminal if I hid from people that you could make almost 14 by risking your money, taking some losses, holding your breath, and giving it the time to come back, because the end result worked out so well for you. But I don't care about the traffic report from 1978. I don't care about the weather report from 1997. And I don't care about rate of return from a 29-year period that's not today, because the most important 29-year period you're ever going to have, or 35-year period, or 50-year period, is the one that starts the day you retire. It's not looking back in time. It's what's going to happen over the next 20, 30, 40 years. Well, look at January 2000 to December 31st, 2019. This is a 19-year period where the same exact tool made a real rate of return of 6.01 before advisor fees. Most people for this 19-year period, by the way, folks, this was before the crash of April and May of 2020. So it's the 20-year average right now is probably about 4.5 to 5%. But before fees, 6.01, after fees, literally people had only made in 19 years 4.5 to 5%. And that is not enough to support a retirement income. Your chance of running out of money is almost 100% if you're taking out what they suggest, 4 or 5%, something like that. Now, what people don't realize, and you can talk to the person who gave you this video about these tools that people don't even know exist. For 20 or 30 years now, we've had strategies that are offered mostly by insurance companies and banks. The brokers still favor selling mutual funds and stocks and bonds. But there's strategies called indexed. And it's not a great name, but what indexed means is when the market, we're looking at an index, like we're looking at the S&P 500 index, maybe 1 year at a time or 2 years at a time. And when the market goes down, the bad news is you don't make any money that year, but you don't lose any money. So you don't make any money. So in a year like 2000, market went down 10.14, and you had put $500,000 nest egg into a safe strategy to either not lose it before you retire or preserve it during your retirement years. That year, your advisor on our team is going to call you up and say, hey, bad news, we didn't make any money. But good news, I protected you from losing $51,000, because look what would have happened if you were in the S&P 500. There are no losses. There are no years that go below zero, just 0 years. So in that year, we'd have 11.28% more money in the safe strategy. Well, what are we giving up? We're giving up that super high upside potential. When the market goes up 30% in 1 year, 40% in 1 year, we have a limit. You do not get it all. It's none of the losses, only some of the gains compared to all the losses, all the gains. Well, here's a year where the market went up 26.38. Stock account grew, but it had taken a huge hit for 3 years. Our account only went up, what is that? 13 point blah, 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 whatever it is. The Excel spreadsheet did the math in the background. So we went up less than the other account. The next year, we got half of that, right? The next year, we got half of that. The next year, we got half of that. Next year, we got half of that. Then we did not take a loss. when the stock account went from 500,000 to 300,000, imagine that happening during your retirement years. That would be so scary. We either have exactly the same money or we grow by a little, exactly the same money or we grow by a little. Looking over the last 19 years, which is long-term in anybody's book, 19 and a half years, really. If you look at the date that I did this was on May 18th of 2020, I believe, because I wanted to include the most recent crash. We have 31% more money. Remember, what is retirement about? Growing your nest egg, not rate of return. It's the size of the account that you can live off of and the income you can take. We have 31% more money in the limited strategy than the one that worked in the 70s, 80s, or 90s. A huge change has come in the market over the last 20 years. So what we're suggesting for people is learn something you've never learned before. Talk to the person that was gracious enough to share this short video with you and say, can you teach me more about these mystery tools that protect you from the market when it goes down, and then when it goes up, you only get half the gains? And how can they afford to do that? Can't they go out of business? And how do they cover those losses? The answers are going to enlighten you. Here's a picture of what it would have looked like over, I guess this is what is this? 1999 until now, right? It's during this dangerous period that we're talking about, the last 20 years. Putting your money straight into the S&P 500 or another type of indexing account. Some indexing accounts have a participation rate, like I showed you. They said you only get 50% of the growth. Well, you participate in 50% of it. You don't get it all. This one says there's a cap, a ceiling. You get the first 12 and nothing above that. Only getting the first 12, limiting your upside potential, but making sure you never lose money over this most recent 20-year period, your account would have grown to $492,000 in the limited safe strategy instead of $282,000 in what used to work in the 70s all the way up to 1999. A change has come. Now, who knows this? Tony Robbins waited 18 years to write a book, and then he wrote a book that was 600 and something pages. In his book, he suggests exactly what we were suggesting. Stop losing money, have a guaranteed income in retirement, and stop losing money. The Power of Zero is probably the best short book anyone could ever read who's either looking towards retirement or preparing for retirement. This is how to be in a completely 0% tax bracket. If you could read one short book and eliminate all of the taxes that you would pay from age 65 to age 100, or as long as you can live, 20, 30, 40 years of taxes. So you may be saving $1 million in taxes, 500,000 in taxes, 2 million in taxes. If one small book could eliminate 100% of your retirement year taxes, wouldn't it be worth reading that book? The answer is yes. I've shared this book with so many people. Are taxes going up or down? Just answer that question. If you say, I think taxes are going up, which is basically how everybody answers, and that was before the coronavirus bailouts. Yes, the country's in trouble. We can't afford even Medicare and Social Security. We believe taxes are going up. If that's the case, then why are we saving taxes on, why are we saving on lower taxes only to pay taxes, the higher taxes later? So if you think taxes are low today, and you think they're going to be higher later or go up for the rest of your life, why would you put money into 401ks and IRAs trying to save tax today, get that deduction right now, and postpone it until later when you think they're going to be higher? Think about that. Why would we want to avoid tax on a small contribution only to pay taxes on much larger distributions? What do I mean by this? Most people, when they look at saving in IRAs or 401ks, it goes something like this. Put $6,000 a year away in your IRA for 30 years, and when you retire, you have a tax-deferred account, and then you can take out that $30,000 a year that I showed on the sequence of return risk on that slide with Steve and Bill, and I think it was Jim. So you put a small amount in, $6,000, and take a big amount out, $30,000. That's how retirement planning works. Well, why are we trying to save the tax it would cost us on $6,000 and trading it for the tax on $30,000? Say the tax is 30% to make the math easy for me. I don't care what it's going to be, but 30% of $6,000, you save $2,000. 30% of $30,000, you pay $10,000. That's odd. Now, that's if taxes stay the same. If you think taxes are going to go up, it gets even worse. So again, why are we putting money in 401ks and IRAs and postponing taxes to a later date when we're going to take out large chunks and we think the taxes are going to be higher? Are you aware of something called provisional income, that when you take taxes from an IRA or 401k, I'm sorry, when you take income from an IRA or 401k, it triggers the IRS's ability to tax your Social Security up to 85%. That doesn't sound very smart either. This book, The Power of Zero, and our advisors can show you how to completely avoid that problem, which we call the tax torpedo. When do you have more tax deductions, now or later? Most people have never thought of this. During your pre-retirement years, your accumulation years, you have a mortgage that you're writing off. Many people mistakenly try to pay it off by the time they're in retirement. They have no mortgage tax deduction. Then most people have no kids living at home during retirement. Maybe you do, most don't. Most people are no longer contributing to 401ks and IRAs. So three of the biggest deductions that you were used to during your working years are now gone. And because of inflation, your income needs to be higher 30 years from now, 10 years from now, 20 years from now than it is. Higher income means you're in a higher tax bracket, lower deductions. You will be paying more tax if we don't do some careful planning ahead of time. Retirement planning becomes really simple if you believe that taxes are going to go up, because we only have three options. And I'm sorry if you don't like these options, but with these three options, we can work miracles and beat every financial plan that's based on the stock market and IRAs and 401ks and things like that. We have municipal bonds, we have Roth IRAs, and we have some types of cash value life insurance, but not the one that you're going to hear the bobbleheads talking about on the radio, saying it's terrible, high expenses, low growth. It's not the whole life from 40 years ago. It's built like a cop car. When police, for many, many generations, the police, what do they call that? I don't know, it's not an agency, but police departments. The police departments in Canada and the United States almost exclusively used what was called a Crown Victoria. If you bought a Crown Victoria car from a lot, you go, well, it's not a sports car. I mean, it's not amazing. It's nice. And that's how people talk about cash value life insurance on the internet. And I agree with them. Poorly structured insurance policies do not make for good investments. They don't grow well. We agree. Everyone's on the same page. But you can't throw the baby out with the bathwater. You can't say musicians don't make good money, because most don't. Some musicians make very good money. Anybody famous you've heard of. What did the police do to make the car do what they want and function the way they want? They souped it up. They made some changes. They customized it. New engine, new interior, better this, better that. That's our job as honest advisors, is to take up, if the only tools you can use are municipal bonds, Roth IRAs, and cash value life insurance. Municipal bonds have some significant issues. They don't pay very much, and you're trusting a government or state or a city or whatever not to go out of business. Roth IRAs have limitations on how much you can put in, and generally speaking, they're going to be put into the stock market. So we have all the problems I talked about with average rate of return and ending up with a smaller account, having it not be safe to take income out of them. Cash value life insurance, we have the problem that the standard stock version is very expensive, chews up all your rate of return, and you can't accumulate any money, but it's tax-free. They call it the rich man's Roth IRA in Tony Robbins' book. But the good news is this: we as insurance agents, any good advisor is going to be an insurance agent or carry that license. We can go in and eliminate so many of those expenses. Now, our commission goes down, so you barely ever see this out in the industry, but for those of us that have the integrity and a passion for tax-free retirement, we can go in and eliminate most of those expenses for you and get a properly structured insurance policy to function like a cop car. It can beat everything when we test it over the last 20, 30, 40 years, and creates tax-free distributions that do not trigger you to have to pay taxes on your Social Security income. If you'd like to be in a 100% or a 0% tax bracket, like literally don't pay any taxes during retirement, we can do that in our sleep. Talk to the person that gave you this video. There's one thing that messes up a retirement plan. If you have a big, giant, fat pension, and I don't mean it messes up your retirement plan, because pensions are awesome. It just messes up the 0% tax thing. If you have giant pension income, we've not found any strategies, I don't believe they exist, to eliminate all the taxes on the pension. So you got to pay taxes on that. But taxes on Social Security, taxes on your nest egg that you saved up in IRAs, 401ks, or just accounts, we can eliminate all the taxes on those with a 0% tax planning. We look at retirement planning differently than the average broker. Hope is not a retirement plan. Sticking money in a diversified portfolio of stocks, bonds, and mutual funds, a little more stocks when you're younger, a little more bonds when you're older, that is like caveman level financial planning. It is not comprehensive. It's out of date and it's proven not to be working for the last 20 years and incredibly dangerous if you're going to actually take an income out of your portfolio, which is what retirement's about. Retirement planning needs to be comprehensive and look at everything. So we use these three models, the three N's. You've got to have in-case accounts, income accounts, and increase accounts. Definitely the most important when you retire is the income account. Piggy banks, paychecks, potential. Emergency fund, some sort of source of income, and some sort of growth to cover medical expenses, inflation, any inheritance you want to leave behind. You will end up with these three types of money with us. Every plan we build is going to pass the 5 lives of retirement test. I don't know if you're going to have a long life, a short life, a rough life, a sick life, or just die peacefully and move into the next life. But a portfolio of stocks, bonds, and mutual funds fails 4 of these tests. It doesn't provide lifetime income. It provides income until you run out of money. It doesn't provide lifetime income for a person if you pass away early. It provides whatever account is left in the stocks, bonds, and mutual funds. So if you run your account down, like Steve or Jim or whoever the two were that didn't have a lot of money, if you run the account down and then die, and your spouse is left with an account of $150,000, they cannot live off of that on the same income they've been used to. Rough life, stocks, bonds, and mutual funds do an okay job. They're accessible. Sick life, do stocks, bonds, and mutual funds pay for your long-term care facility? Do they pay for your nursing home when you get sick? No, you just have this pool of money, and when you spend it, it's gone. So if you get sick for 2 years and spend $8,000 a month draining your account and then pass away, we've got the same problem as short life. You've just left your family destitute. All of the plans we build will take care of long life, short life, rough life, sick life, and the next life. You will have guaranteed income as long as you both shall live. If one of you passes away, the other person will continue to get the same income or higher. You have money that's accessible, growing, not sitting in the bank, but growing at stock-like returns, but is accessible for emergencies. You will have, and I know it sounds too good to be true, ask the person who shared this video to connect you with one of our advisors and show this to you. We don't charge planning fees on purpose. People do not like planning fees. We do not charge them. Sick life, we are going to teach you how do you get insurance companies to pay for your nursing home expenses and your medical expenses without you having to pay out of pocket for premiums every month. This is not pay them $500 a month and hopefully if you do get sick, they'll pay for it. But if you don't get sick, you're out all the money. This is, we're going to park our retirement planning assets with you anyway because we want them to grow tax-free. And if you happen to get sick, the insurance company will fork out hundreds of thousands, if not millions of dollars of extra money out of their pocket, not your accounts, to pay for your long-term care. Last but not least, the first model I created in 2005 when I first got into the industry, financial planning and retirement planning and making smart decisions is not just about your investment accounts. It's not about where the money is. It's everything that costs you or, everything that is an asset or a debt. So mortgage planning, estate planning, retirement planning, insurance planning, and tax planning. When was the last time a qualified advisor, qualified merit planning advisor, reviewed your mortgage plan, estate plan, retirement plan, insurance plan, and tax plan, brought it up to date, and made sure that all 5 were working harmoniously together? The answer for everyone I've asked in 16 years, thousands of plans, is never. Charlie, no one's ever looked at it that thoroughly or comprehensively. Wait until you see the results when we include all of the parts of your plan. Last but not least, we're going to take you through a simple 5 lives of retirement test on your current plan. This is not to embarrass you. It is not bad news. You are super intelligent. You're a genius when you see clearly. And we know that you've done the best that you can with the information that you had at the time. If we bring you some new information in a very safe, comfortable way, what we know about you, because you are a genius when you see clearly, is that you'll make really, really smart decisions, and we will be able to help you. This simple test, we're going to ask you some questions about what you want, and everybody answers the same. I don't want to run out of income. I want my spouse and family to be okay if I die early. I want access to my funds, but I want them growing at a high interest rate, not sitting in the bank. I want someone else to pay for my long-term care if they're offering, and it doesn't have to come out of my money. And if I pass away, I want my inheritance to be passed along based on my wishes, not to go to the IRS and not to go to the black sheep of the family who's on drugs. You want your inheritance to go the way you want. Over 99% of the plans we reviewed, because they're based on stocks, bonds, and mutual funds, the diversified portfolio of risk with a side of fees, just kind of a gambling approach from the 70s and 80s that used to work, that no longer works, but still feels comfortable to people. Your current plan, over 99% of the plans we reviewed, get red, red, yellow, red, red. They fail the long life test. If you run out of money, you run out of income. They fail the short life test. We don't know your spouse is going to be okay. You have some liquidity. You can get your money. No one's paying for long-term care. It's got to come out of your account. And you have no idea how much is going to be left over when you pass away, because there's no guarantees. It's just when you die, what the rate of return was like, how much of the account is left, and how much taxes I'll have to pay. Every plan we offer is green, 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 green. So the advisor you work with is going to ask you, after doing the test, this little drop-down menu, I've already chosen it. It says fix or ignore. Mr. and Mrs. Jones, when you run out of money, you're going to run out of income. And based on sequence of return, that could be in 10 years, 15 years, 30 years. But would you like to run out of money before you die? No. Wonderful. We can fix that. Would you like us to fix it or ignore it? And we're just going to ask you that simple, safe question for all five. As you can imagine, most people come back and say, would you please fix all of this for me? And I understand it can be kind of uncomfortable to say goodbye to someone who's been managing your money for a long time, or maybe it's a family friend. But if I could just encourage you, something that we've sort of lost sight of is there's 8 billion people in the world. And you've chosen one of them possibly to, grow your money, or to manage it, or to invest in stocks, bonds, and mutual funds, or whatever it is. What are the chances that that choice you made, doing the best you could at the time, as the world changes, what are the chances, what are the probabilities that that's the one person out of 8 billion that's really the best at mortgage planning, estate planning, retirement planning, insurance planning, and tax planning, and is going to get you to and through retirement with the maximum income and lifestyle that you need? Isn't the probability way higher that someone else out there was better and you just hadn't bumped into them yet? Breaking up is hard to do, but let me encourage you. It's just business. This is your money. If you need to leave an advisor, some of you may not be with an advisor, that's fine, but a lot of people are. If you need to leave an advisor that doesn't do the type of planning, they're more focused on stocks, bonds, and mutual funds, and sort of accumulation planning and risk-based stocks, basically risk-based diversified portfolios. If you need to leave somebody like that, we can show you how to do it in a very comfortable way. But we are here for you. Please talk to the person that shared this short video with you. My name is Charlie Jewett from the Renovating Retirement Podcast, and I so hope that this was helpful for you, to your success.